Retirement isn't tax-free. Over the years, I've seen many people walk into my office shocked by the amount of taxes they owe in retirement. But here's the thing, taxes, they just don't show up on April 15th. They require year-round planning, especially when you're retired. Hi, I'm David Fontaine, and today I want to discuss tax planning in retirement and why planning ahead is more important than ever. So, what are the most common mistakes retirees make? Well, here are the top 3 mistakes I see retirees make in retirement. So, number 1 is most people only think about taxes in April. Sure, you're retired now, you're enjoying some time on the beach, you're hanging out with your grandkids in the park, but during that time, you really should have taxes on the back of your mind. Your comfortable retirement depends on a solid tax plan. Taxman doesn't retire just because you do. So you want to keep that in mind. In fact, taxes in retirement can become even more complicated if you're not prepared. Number 2, different accounts are taxed differently, so you got to plan carefully around that. You see, your IRA is taxed differently than your Roth IRA, and your Roth IRA is taxed differently than your taxable brokerage accounts. And keeping track of all these differences, it can get confusing without solid tax retirement planning. That's why I make tax planning a top priority when working with my clients. What happens is your regular IRAs are funded with pre-tax dollars while you were working and saving, but now it's time to withdraw, for example, and when you're retired, and your retirement tax plan needs to account for the IRS bill that's going to come due on those funds. So you got to plan ahead for that. Regular IRAs are taxed as ordinary income, and withdrawals are subject to ordinary income tax rates, which those can get progressively higher the more you withdraw. This means that larger withdrawals can push you into a higher tax bracket, leading to more taxes owed and even triggering Medicare surcharges. Now, what happens with the other types of accounts, your taxable brokerage accounts, those are taxed for capital gains, which they can be taxed at 0%, they can be taxed at 15%, they can be taxed at 20% for long-term capital gains, and that's all depending on your overall income. You see, now finally, Roth IRAs are tax-free because you funded that money with money that you've already paid taxes on. This makes the Roth withdrawals a valuable tool when managing your tax bill in retirement. With all this said, withdrawal strategies matter. If you're not careful, you could give the IRS a bonus that you didn't intend to give them. Number 3, timing withdrawals properly can reduce your taxes. So should you withdraw money from your IRA, your Roth IRA, or your taxable account first? The answer is it depends. It depends on your income needs. But here are a few general tips to help you with retirement tax planning. To effectively manage your taxes in retirement, consider withdrawing or converting funds each year in a way that helps you keep yourself in lower tax brackets, both for income taxes and Medicare costs. Large withdrawals can push you into higher tax brackets, so it's important to avoid those as best as possible. Another is reduce the tax-deferred balances that you have before you're required to take your required minimum distributions, and this can help avoid higher taxes, increase Medicare premiums, and higher Social Security tax rates. Another is use Roth conversions during low-income periods, such as an early retirement or job transitions, to minimize required minimum distributions and then create tax-free income for yourself down the road. With all this said, poor coordination can push retirees into higher tax brackets and derail their retirement. If you have questions about retirement planning and withdrawal strategies, reach out to me today. Let's start planning your retirement together.